Welcome one and all. Before going into presentation, I will first tell about the TCS results which came after market hours yesterday. It is the first major company to kick off the result in current result season. Already we all know that IT sector is one of the biggest underperformer in recent times. Many large cap ITs has corrected by 20%, more than 20%, while mid cap and mid cap IT companies, well-known companies like L&T Infotech, Mindtree, LTTS, they have all corrected by 40-50% from the recent peak. TCS results were slightly disappointing. Though revenue came in line with expectation, there was margin pressure, mainly because of wage hikes, that cross-currency headwinds, visa cost, and travel cost again coming back. So overall, there is a big margin pressure in IT companies. In TCS, top line revenue went up by 13%, whereas the profit after tax has grown by 5% year on year, while on sequential basis, the profit has come down by 5%. We expect that TCS stock will be range bound in coming days. We don't expect big upside. Management commentary also very cautious. Previously, they used to tell that demand environment is very strong. Now they have started telling that demand environment is very stable. The well-known IT analysts, they were all telling that next year we may see some slowdown in IT spending, which may affect Indian IT companies. Generally, IT sector is one sector where market analyzes well, and they used to discount well in advance before actual event happens. And that is why if you see that most of the IT companies have corrected in anticipation of weak environment next year. So the real impact, any demand impact will be seen from second half and next year in IT company results. So we expect that IT companies overall will remain lackluster in near term, and TCS will be range bound. Now coming into the presentation, market overall in consolidation. Last 1 month, in the month of June, market fell very sharply and it has bounced back. And if you see in the last 1 month, Nifty, Sensex, mid cap, small cap almost ended where they have started 1 month back. They fell and again they have bounced back. Now there is an expectation that July will be relatively better because consecutively April, May, June, all the 3 months market has given negative returns, and it is expected that the July will be better because of oversold condition, and historically we never had 4 months of negative returns. So on that basis, it is expected that July will be much better. And if we turn on any business channel or any media, there is a big fear that recession may come into US and Europe, at least in the second half of 2022 or in early 2023. So market has already started discounting the recession fears. Recession is something like 2 consecutive quarters of GDP contraction. That is what called recession in US. So if foreign portfolio investors, they are very cautious. I will tell why they are very cautious in coming slides. And US Fed, they continue to be very hawkish. They want to reduce the inflation at any cost, even at the cost of slowdown in economy, or even economy goes into recession. They don't want to worry about that, but they want inflation to come down, which means that US Fed is going to hike interest in the month of July. That is in current month when US Fed meeting is there. Then August we don't have any US Fed meeting. Then in September another meeting is there. So 2 meetings they are likely to hike by anywhere between 75 basis point to 125 basis point. So overall, what we are expecting is that market will remain range bound and the focus will be on result season. Nifty, Sensex, mid cap, small cap, all have given a flat return in the last 1 month. foreign portfolio investors, they are very cautious. You can see that daily some foreign institutions will be called for an interview in CNBC channel. And if you see that, everyone will tell that they are very cautious on Indian market. The main reason why, the reason they are telling that why they are very cautious and they are very negative on Indian market is that the valuation still very high. That is the main reason they are telling that they are very cautious in our market. And what they are telling is that most of the other markets, they started trading at a discount to their historical valuation, whereas in India the valuation is still premium to the historical valuation. So that is the main concern they are telling. And what they are telling is that they are selling in our market and they are taking back money and they are investing in other markets where the valuations are very attractive. And many foreign institutions, they tell that they are investing in markets like China, where the valuations are extremely attractive. And we all know that FIs has been continuously selling, and from the peak they have sold almost to 5.2% from their holdings. And overall around $35 billion they have sold since October in our market, and most of them has been luckily absorbed through mutual fund buying and institutions buying and retail buying. We in spite of that much selling, we did not see much impact in our market like in previous time. So FIIs have sold almost $35 billion worth of shares in our market. And if you see which sector they have sold more, generally one who holds the shares overweight in some sectors. If anything they want to sell this, they will sell that sector only. And if you see in this table, FII have mostly sold mainly in financials and IT. Financials, they have sold almost 1 lakh worth of shares, and in IT they have sold almost 76,000 worth of shares. So majority of the selling has come in these two sectors, financials, then IT. And if you see that these are the main big holdings for the foreign institutions, and that is why they have sold these shares. And we expect IT will remain range bound in coming days also, because of some of the slowdown concerns foreign institutions expect in IT sector in next year. And the overall weightage, if you see that around 31% is in financials and 12% is in IT. That is what the main weightage they have. Oil and gas 13%. Luckily, because of last 6-7 months, there has been a huge rally in oil and gas sector. They are still holding it. They did not sold much. Whereas in discretionary consumption, actually for foreign institutions, they hold higher weightage than what they have in the Nifty. Almost 12% they have in discretionary consumptions, while in Nifty weightage is around 9.3. The other sectors, there was not much selling. FMCG, some marginal selling was there. Construction materials, there was some selling, whereas in other sectors, not much selling is there. So the main focus for foreign institution was in financials and IT, where they sold more shares. And this is the slide which I last time also I showed. And if you see that in the last many FII selling time, that is from 2008 to now currently 22, if you see that FIA has sold many times. The major one came in January 2008 and March 2009 during the global financial crisis, where foreign institutions sold around 15 billion worth of shares. And if you see that as percentage of Indian market cap, they have sold around 0.9%. And on as a percentage of finance, their FII holdings, they have sold around 5.2%. And in current correction, if you see that FIIs have sold 35 billion worth of shares, and as a percentage of Indian market cap and as a percentage of their holdings, it has almost matched what they have sold during global financial crisis. In every other correction time, it was not as steep as we are seeing now. And before that, they have sold 9 billion, 8 billion, whereas the percentage of the holding, it was much lesser. So the current sell-off, we can compare with the global financial crisis in January 2008 and March 2009, where they sold heavily. But the big difference is that in January 2008 and March 2009, during that FII selling, Nifty and mid cap index fell more than 50%. Whereas now in this current correction, Nifty has come down by around 15-16% only because of heavy buying by mutual funds. So the impact on the market, in spite of similar sell-off by foreign institutions during January 2008 and 9, is far lesser this time when compared to the previous big sell-off, that is during global financial crisis. And this is the foreign portfolio investment sell-off. In FY22, they sold off around 18.4 billion. That is from April to March. But if you see from October onwards, October to March, they have sold almost 21 billion. In the current financial year, in the last three months and 1 week, they have sold around 14 billion. So if you combine between FY22 and from FY23, that is in current financial year, almost 35 billion they have sold. Even though here it comes around 32 billion, but if you take from October onwards, the overall sell-off will come around 35 billion, which is almost equal to whatever inflow we had it in FY21 during Corona fall and rise. There was huge buying by foreign institutions, and that entire bought amount has been sold off. And FY19 and 20, there was no inflow. So if you see in the last 5 years, the overall net foreign institutional inflows has become almost nil now. So in the last 5 years, there was no major inflows from foreign institutions. It is purely by mutual fund and domestic retail investors who have pushed up the market, who gave liquidity into our market. This is the commodity index. As I showed in the initial slide, that commodities has corrected. So this is the Crb Commodity Index, which is a widely tracked commodity index. And if you see that from the peak, almost it has corrected by 15% it has corrected from the peak. And this index, if you see the index composition, Crb Commodity Index, roughly 40% consists of energy, that is oil, natural gas, coal, like that. That constitutes around 40% of the commodities index, Crb Commodity Index. Another 40% is agri, cotton, wheat, like that. Another 40% is there. And 13% is the base metal, steel, like hard commodities. And balance 7%, the composition is precious metal. So 40% energy, 40% agri, 13% metals and steel, and balance 7% is precious metals. So that is the composition of this commodity index. It has come down by from the peak of 350, it has come to 294, almost 15 to 16%. It has corrected from the peak, and because of this fall, now recently we have seen some rally. There is a hope that inflation will come down because of the fall in commodity prices, and that hope has led to short-term recent rally in our market. But whether the fall will sustain or we are going to see steep fall, and next slide I will tell. And this is the long-term chart. Previously we saw the last 1 year chart, and this is the long-term chart. And long-term chart, if you see that in many times the commodity index has corrected very sharply. In 2008-10 period, it has come down by almost 50%. It fell in the matter of 1.5 years. From 450, it fell to near to just about 200 because of global financial crisis. Then in 2015 to 17, it fell very sharply. This is mainly led by fall in energy prices. Since energy has almost 40% weightage in the Crb Commodity Index, at that time, crude oil prices fell very sharply from $110, $120. Crude oil prices fell to $30. Almost more than 60% correction was there in crude oil prices. That is why the Crb Commodity Index fell sharply during that period from 2015 to 17 period. Now it has gone up very sharply. Now we have seen the correction. My personal view is that, based on what I read, is that we are not going to see the steep correction like what we have seen in 2008 as well as in 2015, because at that time crude oil price fell very sharply. We are not expecting crude oil price will fall very sharply now, because the inventory levels are extremely less globally. That means any fall in crude oil prices, countries will rush and buy the oil to fill the inventories. So at least in the next 3-4 months, crude oil prices are not going to fall very sharply. Maybe in the late second half or by next year, the crude oil prices may fall. But in near term, we are not going to see big fall in crude oil prices. So if crude oil prices doesn't fall, means naturally the 40% weightage in the Crb Commodity Index is not going to come down like what we have seen in the 2008 and 2015 period. The second thing is that there is a big hope that the recession will come in US and Europe and in many other countries. Nomura says even in Australia also recession will come. Nomura is expecting. So even because of that, the base metal prices has come down very sharply. The biggest casualty was seen in copper, because copper is mainly used in house wiring and other capex. And any recession, the first metal that used to get hit consumption is the copper, and that is why the copper prices has fell very sharply in anticipation of the recession coming. But if you see the London Metal Exchange inventory, the inventory level are extremely less. So we don't expect, based on the inventory level and the geopolitical situation we are seeing now, even if demand comes down, we don't expect steep fall in commodity prices like what we have seen previously. The other major thing that will give support to commodity is the supply factor. Now what has happened is that last 2 years, most of the commodity companies made bumper profits because of unexpected sharp increase in the commodity prices. So because of huge profits, and many of the companies has reduced borrowings. Even in our country, if you see that Tata Steel, from more than 1 lakh crore debt, they have reduced it to 50,000 crore debt. Similarly, SAIL, if you take, more than 50,000 crore debt was there for that company, SAIL. That have come down to less than 20,000 crore. And because of a huge deleverage, the balance sheet strength is there. Now, what will happen? Suppose if recession demands comes down, means what will happen is that companies, they will start reducing the production. So the supply, they will reduce it. Since the balance sheet is very strong, they can withstand lower capacity utilization. So they will try to manage the supply side so that the prices will not fall much, as well as they can postpone the capex also. Tata Steel, if you take, they have announced certain capex now. Suppose if steel prices starts coming down, means they will go slow with the capex, which means that future supply also will come down less. So this is the big contrast with what we have seen in 1980s or 2000, like that, where the companies companies took huge debt and went for capex, whereas now the debt level is very less and the capex, they are not going much. That means that supply, they can reduce it without much issue, and thereby they may manage the prices. In 1980s and 2000, the interest rate was very high. 1980s, 1990s and all. Company will take debt and they will go for capex. Even if commodity prices are very weak, they have no way but they have to run the company, because the interest rates were around 18%, 19%, like that. And if you borrow money and you have put a plant by borrowing that money, means you can't keep the plant ideal. So in spite of running into losses, the company keep on running the plant. In spite of knowing that they have to sell the product at a loss, they have to keep on running the plant because they have to pay very high interest. That is not the case now. There is a balance sheet strength is there, and commodity company can easily manage the company by reducing the supply. And the company is unlikely to get affected. That is what my case is, in previous down cycle. And the other important macro headlines we are seeing is that rupee has been touching new low. One of the reason why rupee has been continuously getting weakened is that because of very high trade deficit. So the upward is the export our country is making, and bottom is the import. And if you see that exports are gradually coming down for the last 4 months, exports has been there is some demand softness globally. Because of that, exports has been coming down from 42 billion, it fell to 40 in the month of April, then to 39, then 38. So exports has been gradually coming down. Whereas if you see the import, which I have put it in the bottom, it did not fell. Actually, it has gone up in the last 2 months from 60 billion. Now it has gone to 63 billion. Because of this mismatch, exports coming down, imports going up, the trade deficit has gone to 25 billion, which is very high. So the trade deficit has to be balanced. Otherwise, the rupee will get depreciated. So what used to happen is that there's a trade. It is a hard commodity exports. The trade deficit every month you see in newspaper and you see in TV. It is the mercantile export and import. The mercantile means it is a hard commodity. Whatever we export, like textiles, engineering goods, all will come in this. Imports mainly it is crude oil, gold, like that, and it is all hard commodity that will get reflected in the exports and import. And because of that 25 billion, it has to be balanced somewhere, because every month India has to pay 25 billion worth of dollars to the purchaser, and this 25 billion, a part of it is financed through, balanced through IT exports. This is the trade export. Then we have services export, where services export we have surplus, and that surplus, because thanks to the IT sector, and IT sector we export more than what we import in services side, and part of this 25 billion monthly deficit is financed by IT surplus in IT exports. Then we have NRIs who are working abroad, they will send money, and that will also give some cushion to the trade deficit. And the surplus of the deficit of all the three will come under the current account deficit. So current account deficit of three parts. One is the trade deficit. The second one is the IT the services sector. So the current account deficit has three parts. The first one is the trade deficit, where we have huge deficit. Then we have services surplus we have. Then we have NRIs who transfer money, that is also a surplus. So NRI transferring money, IT services surplus, then trade deficit. This combined together, still we have deficit, that is called the current account deficit, and it has to be balanced by capital account, where FII flows and FDI flows will come. Then we have governments taking loans, and if current account deficit is not balanced by capital account, then we will start seeing the reduction in the reserves, and that is why we are seeing that our reserves has been falling. At one point of time, our reserves was 650 billion, and as on yesterday, it has fell below 590 billion, because the current account deficit is not balanced through capital account. We all know that FIs has been selling. That is why the capital account also there has been some deficit is there, which has been taken over from the reserves, and that is the reason why the reserves is falling continuously. And this is the current account deficit historical chart. And if you see that historically, our country generally, if you see that our country always runs in current account deficit, except in few periods of time, like 2003 to 2002-3 time, we have some current account surplus, as well as during the COVID time, we had some current account surplus, because at that time crude oil prices fell very sharply, and a trade deficit was not there. That is why we had some current account surplus. But all other time, our country used to have current account deficit. And if you see that some period like 2012, 2011, 12 and all, our current account deficit was extremely high, more than 4% of our GDP. Actually, at that time, India was classified as one of the fragile 5 countries in the world, where there is a potential breakup like what we are seeing in Sri Lanka now. The same time, the same thing, India was seen at that time as a very fragile country because of very high current account deficit of 4.5, 4.8. Now, in the last year, the current account deficit was 1.7, and it is expected that in current year, the current account deficit will range between 2 to 3%. That is what economists are expecting. But it is not going to come what we have seen in 2011 and 12 period of more than 4%. So India is not in the fragile list. Basically, India has become relatively very strong when compared to 2011 and 12 period. The other important thing which has worried the market is that the government has taken some steps to reduce their deficit as a revenue measure. They have taken some measures, as well as in order to reduce the rupee depreciation. Some few measures has been announced. These are sudden measures, and markets generally don't like this type of measure. Some of the measures they have taken in the last 2 months is that export tax on steel, in order to reduce steel prices to cool off inflation. Government has put export tax on steel 2 months back, where markets gave huge thumbs down to this, and many steel stocks fell very sharply because of that. And in the last 1 week back, government has put fuel export tax. Mainly it was targeted around against Reliance, where export of petrol and diesel, they have put fresh tax. For petrol 6 rupees per liter, as well as for diesel 13 rupees per liter, they have put tax. The rationale for the government to say is that these companies are making huge profits on refining, and they can give some amount of huge profits to the government. That is the rationale given by the government. Government said that the fuel tax will be reviewed every 15 days, and they will take decision by seeing the condition. And similarly, the cess on domestic production of crude also they have put in. It basically affects 3 companies. ONGC is one company, then Oil India. The third one is Vedanta. Vedanta is affected mainly because they took over the company Cain India few years back. That is in the production of crude. So the tax on fuel exports mainly affects Reliance, whereas the cess on domestic production of crude, it affects the ONGC, Oil India, and Vedanta. And they also have hiked the import duty on gold. They want gold is not an essential commodity, and they want to reduce the import of gold. That is why they have hiked the import duty by 5%, from 7.5% to 12.5%. They hiked the import duty on gold. So these are sudden measures. Generally, market generally don't like these type of measures because many of them who are extremely bullish on ONGC because of sharp rise in crude oil prices. Now this has come as a big sudden unexpected disappointment, and ONGC stock fell from 150, 160 level to 120 level because of this. So these are unexpected one, and it may affect sentiments on the investors. The other thing which is happening as a broad base is the tax compliance. Government has become very strict on tax compliance, and it is becoming stricter day by day, because now our PAN number, Aadhaar number, and bank account number, everything has been linked, and if you do any big transaction, IT department can easily find it out. And if you see that on every week, I'm reading that some companies, IT departments were conducting raids on some companies at any point of time. The last one I read was yesterday was that the paracetamol manufacturer, a Dolo brand paracetamol manufacturer, Micro Lab, a pharmaceutical company, IT department. It's an unlisted company. IT department conducted raids on that, and every week we could see news flash or in a newspaper that the IT department has been conducting raid, and it has been they are very strict. Day by day the tax compliance is getting stricter, and it will become very difficult to evade tax in next 2 years, 3 years. You cannot evade tax like that. The situation is becoming, because the PAN number and Aadhaar has been linked with the bank account, and if you do any registration, house registration, your PAN number has been we have to give our PAN number, and that will go to IT department. And if you see in the IT filing site, the annual information system is there, and we can see that whatever shares we have bought and sold, whatever transactions happened in our demat account, that will get reflected in the IT portal. Similarly, the dividend amounts we are getting where TDS has been taken, that also will get reflected. Soon the land transaction, or even if you buy a vehicle, that also will start reflecting in the annual information system, which means that we cannot evade anything to the we cannot evade or hide any big purchases to the IT department. That is what it is happening, and it will get more strict in coming days. And one of the biggest benefit for some of the companies because of the IT department very high and strict compliance is that the organized market share will increase in many sectors. If you see that, for example, Titan, if you see that Tannis is an organized jewelry company, and there are many unorganized small players in the gold jewelry business, and they are finding it very difficult to do business now, because wherever if they want to buy anything, then GST is getting asked. And the small players, the unorganized players, they are finding it very difficult to do jewelry business with black money. And Titan is gradually getting a higher market share, because since it is an organized player, they are getting market share from this unorganized player. That is the reason why the Titan, in spite of very high valuation, most of them are very bullish on Titan on a very long-term basis, 5-year, 10-year basis like that. The main reason is that the unorganized sector will shrink day by day, because it will become very difficult for them to do business, and the organized sector will capture the unorganized sector market share. Monsoon, initially June was a highly disappointing. It was a very slow start, but now the rainfall has picked up well. And if you see the monsoon rainfall, is the deficit has completely wiped out. At one point of time, it was more than 20%, and because of very good rainfall in the last 10 days, the deficit has been completely wiped out, and country as a whole is zero. This is a day before yesterday. As on yesterday, it was 2% surplus from the long period, 2% higher departure from the long period average as on yesterday. And if you see that central India, some deficiency is there, but that deficiency will get wiped out soon. Most probably by today or tomorrow, even the central India will go into surplus. Rainfall distribution somewhat uneven, but we feel that it will get even out in coming days. The IMD still now maintains that the rainfall will be good, and it will be a normal monsoon in this. And if that happens, it will be the fourth consecutive year of normal monsoon. So the monsoon will be very important. Actually, many economists will say that monsoon will not impact economy, but it will have a lag effect. It will have a lag effect. Maybe if monsoon is bad this time, means it will have negative impact next year, not this year. It will have a negative impact 1 year down the line, not immediately. And the last 3 years it was good, and this year also it is expected to be good. US Fed commentary is very hawkish, and initially I told that US is very hawkish they want to tame inflation. Even if economy gets hurt, they are not bothered about the growth, but they are mainly concerned with the inflation to come down. And wherever US Fed officials talking, wherever US Fed chief Jerome Powell says, his main objective in the near term is going to be to bring down the inflation. That is what the statement he says. Already Fed has hiked interest rate. In the month of June, they hiked the interest rate by 75 basis point. In July, another 75 basis point they are going to hike. And in September, they are going to hike 50 basis point. So more hike is going to come from US Fed, and the terminal interest rate in the near term, it is expected that US Fed will make it to 3%. That is what the expectation. And after that, depending upon the inflation scenario, they will take action. But in near term, the US Fed interest rate will come to 3%, which is higher than pre-COVID level. And this is the mortgage rate. And if you see that the mortgage rate has already started going up, and it around more than 5.5% now. The mortgage rate was double than what we have seen during the COVID bottom. During the COVID bottom, the interest rate fell to 2.65. Now it has come to 5.8%, more than two times what we have seen in the during the COVID bottom. And this is the rate which has been seen during 2006-7 period. And after that, always it was lower than that. And interest rate has gone up very sharply, the mortgage interest rate. And because of that, now what is happening is that the housing sales has come down very sharply. And if you see that the new home sales, it has come down almost 30% fall we have seen from the peak. But still, it is near to the pre-COVID level. We are not seeing huge collapse in US new home sales, but it has come down by 30%. So now what economists are saying is that US economy is not going to collapse because the balance sheet of individuals are very strong. They are having huge savings. COVID time, because of travel restriction and work at home, there has been huge savings of money with the individuals, which is lying in the bank. And because the corporate balance sheets are strong, and because of that, the recession we are going to see is going to be very mild. We are not going to see a huge panic fall in the US economy like we have seen in 2008-9 during the global financial crisis, like that. Maybe the mild recession we are going to see, which can be manageable. But US Fed is increasing rate. So what we are going to see overall is that because of mild recession, we are going to see mostly time-wise correction in many financial instruments like shares and as well as in hard assets like housing. Because of the mild inflation, we may see time-wise correction, not price-wise correction like we have seen in previous crisis in 2008 and 9. Q1 earnings. Yesterday we had TCS. It was a slightly muted results. There was no major positive surprise in that. Maybe in next 2-3 quarters, IT company is going to see lackluster stock price movement. And the commentary from Infosys will be closely watched among IT companies. Yesterday TCS came. This time Infosys is going to come out with the results on June 24th, which is on Sunday. Very rarely big companies announces result on Sunday. This time Infosys has chosen to announce its results on Sunday. My expectation is that before going into Infosys results, market will be very cautious because they are going to announce results on Sunday, and market has been expecting that some negative surprise may come out with the results. That is why Infosys is coming out with results on Sunday, and we have to see. And before going into results, most of them will remain very cautious on Infosys. And in other manufacturing companies, what we are going to see is that there is going to be a huge margin compression expected because of sharp increase in the commodity prices. But what will happen this time is that the outlook on margin front will turn positive because the commodity prices have seen some correction from the peak, and because of that, we see that the margin uh, front, they on the outlook on margin front, most of the company may tell that the worst is behind them. That is what we are expecting it. And some of the chemical companies, we may see some huge inventory losses because the prices come down very sharply in some cases, and for them the inventory loss will be there. In metal packs, the peak profit is behind them, whether if you take aluminum companies or copper companies or steel companies, the peak profit is behind them. From here on, the profit will come down gradually. And banks is one sector where we are expecting some good results to happen. It is one sector which may surprise the market on positive side. The main reason is that the credit growth has started going up, which means that banks may margin may go up, though because of higher bond yield, the other income may come down, but the core business will surprise on positive side. That is what we are expecting it. And this is the bank credit versus deposit growth. And if you see that credit growth, which was around 14% in 2019, it fell very sharply. It came to almost 5% during the COVID time, because COVID time, most of the corporates did not need money because of sharp fall in commodity prices. The working capital needed was very less. That is why the credit growth fell very sharply, and most of the companies also postponed capex. They did not need money, and credit growth fell to 5%. Now from here on, the credit growth started going up. Now it has crossed double digit, and as on June 17, 2022, that is last 2 weeks before, credit growth has come to 13%. So double digit after 2-3 years of languishness. Whereas if you see the deposit growth, it is still languishing. One of the reason why the deposit growth hasn't gone up is that banks did not increase the interest rate much. And if you see that RBI 2 times has increased interest rates, whereas the banks did not increase the interest rates much. Maybe for the namesake, they have hiked the deposit rates by 20 basis point, like that. Some banks has hiked the rate, but overall, they did not hike the deposit rates. So the public is not interested, still not interested putting money in banks because they feel the rates are still low. So the now one question arises among all: why, in spite of RBI increasing interest rates, why the banks did not hike the deposit rate? The main reason for that is that there has been a surplus liquidity in the banking system. Almost 7 lakh crore we had it last year, and most of the money has been given to RBI through reverse repo, which is a very low interest rate. Now the credit growth has started going up. Banks started withdrawing money and started lending it, and the 7 lakh crore surplus money we had it in the system. Now that has reduced to 4 lakh crore in the month of April, and in the April-May time. Now in July, it has fallen to 3 lakh crore. The surplus has come, and we expect by August September time, where the main festive season will start, the entire surplus liquidity will disappear from the system, and RBI and banks will start depending upon the deposit money. So by next month onwards, we can expect that banks will start increasing the bank deposit rate to make it attractive for public to place deposit with them. And we expect that the deposit rate also will start increasing. Once the interest rates comes to 7%, means then the many senior citizens, they will start placing the money with the banks, placing deposit with the banks. 7% is the decent return for them, because 1 year back it was just 5.5%. So 1.5% increase means they will feel that the deposits are becoming attractive. So by August to September, we can see a good increase in the deposit interest rates from the banks. Equity mutual fund inflows still very good. Almost 15,500 crores inflow was there in the month of June. And most of the foreign flow selling, it has been absorbed by the domestic mutual fund, and among 15,500 crore, nearly to 12,250 crore comes through the SIP route. So that is the stable money. So the real test will happen after 3 or 4 months. Suppose market gives negative return in the last 1 year, and deposit rate goes to 7%, like that means at that time some of the senior citizens may start thinking that if I can put money in bank, I may get 7% interest rate, but I have put in mutual fund where the returns has been negative to 5 to 7%. So nearly I am losing 14%. Means at that time there is a possibility of a change of mind among some retail investors, and they may move towards bank deposit. So the real test will happen after 2 or 3 months if market continues to be very bad. And triggers for the market terror, as previously I have told, the Russia-Ukraine war has to end, then only the crude oil price will fall. The geopolitical tension will ease out. Now, if you see some of the European countries are struggling a lot, particularly a big country like Germany, where they are not getting enough natural gas from Russia, and they have to shut down some of the factories, and power cost has zoomed up a lot in countries like Germany, where it is one of the high exporting countries among Europe, and if power cost goes up a lot means their export may get affected, and the only solution for that is the ending of Russia-Ukraine war and falling energy prices. For us, the main trigger for big bullishness to come is the fall in crude oil prices for our country. And market has already started factoring the global slowdown. Everyone talking in TV about the US recession, European recession, like that. And generally, market will be ahead of what actually happens, and market has already started discounting it. That's why we have seen that US and US market has fell a lot, and our market also corrected on anticipation of recession. So once recession comes, market would have seen a bottom at that time, and market would have start going up. And the other thing is that global slowdown happens means then the inflation also will come down, because the demand will be lower, and the prices also will get soft. And if you see that inflation is generally seen year on year basis, suppose if 100 rupee product last year, if it is 110 means, then inflation will be seen as 10%. Next year the prices need not to fall for inflation to fall. Even price stays at 110 means the inflation will fall to 0. And global slowdown, the commodity price going up, that may get halt. Even if commodity price does not fall much, the inflation will start coming down. So time is the only heal to the current economic crisis. And like in 2008 and 9, the crisis was very huge, and at that time the central bank has to take extraordinary measures to tackle their situation. But right now that is not the case. Time-wise correction is needed, that will fuel the economy. And what investors should do now, every time I'm telling that, what we are expecting is that the huge price-wise stock correction is unlikely to happen, either in our country or even in US also. Whatever correction has to happen, it has already happened. More correction happened in the Nasdaq, and where many stocks fell by 60-70%. Nasdaq correction started even before the overall correction started globally. And what we are expecting is that huge price-wise correction unlikely from here on, but we are going to see time-wise correction. market may consolidate in near term, and a small up and down will happen. Here and there, some stocks may see some up move, but on a broader basis, market may see some consolidation. And global economy, we are not expecting huge recession, but a mild recession is possible. And I have said previously, gradual buying is advisable. There should not be, one should not fear that we are going to see huge price-wise correction. So gradual buying can be advisable. A stock may fall by a 5 or 10% from our buy price, but big fall very unlikely, and it is very difficult to time the market, and so one can gradually buy. And events to watch: geopolitical tension and Q1 results. We have to see. Already TCS announced it, and more companies will come from next week onwards. And till July 15th, companies have time to announce their Q1 results, and we have to see what they are going to tell. And monsoon. These three are the events to watch. Now I will come to the recommendations. After this recommendation, we have some few charts also that Patmanaban will take. 2-3 charts we are having, technical charts. After recommendation session, Patmanaban will take. So this time we are recommending some five stocks as usual. We are recommending ICICI Bank, that everyone knows that banking sector looks relatively better when compared to other sector. Recently, the big fall in banking is mainly because of heavy selling by foreign institutions, since they hold a huge chunk of banking stocks. In order to sell and exit India, they have no other way but to sell the banking in stocks. Like that, they have sold it. But fundamentals, if you see that, they are relatively better, mainly because of increase in credit growth, whereas the deposit growth is not going up, and that will lead to margin expansion to many banks. The other thing is that NPA cycle has reversed, and most of the provisions and write-offs are already behind banks. Now the next fresh cycle may happen 3 or 4, 5 years later only. So in near term, the provisions will not go up, at least for big corporate banks like ICICI and SBI. And SBI, we are continuously recommending it, and ICICI Bank also previously we have recommended. Those who want to buy a large bank means they can go up with the ICICI Bank. The second stock we are recommending is Century Textiles. We all know that it's a very old company. A company had some BK Birla Group company itself, and they had 3-4 divisions. One was cement division, then textiles they had it, the paper they have. The other big positive about this company is that they have huge land bank, where they are converted into a real estate segment, and they have started building for commercial as well as domestic real estate land development they are doing on the land they are holding it. Company had some issues previously. Because of that, they had some huge debt, and 2 years back they sold off their cement division to the Ultratech Cement, which is actually the relative of the Kumar Mangalam Birla Group, and this is BK Birla Group. Kumar Mangalam Birla is the grandson of BK Birla. BK Birla's son is Aditya Birla. Aditya Birla's son is Kumaramangalam Birla. So actually, BK grandson, Century Textiles sold its cement division to his grandson company, which is the Ultratech. And because of the selling of cement division, now the debt has come down very, very drastically the last 2 years. Moreover, the paper division has been doing well now, because of almost all paper companies are doing well, and Century also no exception. The paper division is doing well. The real estate division is likely to do very well in coming years. That is the main reason why we have recommended this stock, because of the real estate division business, and one can accumulate it. The third one is the IGL, Indraprastha Gas, and company is available at a decent valuation now. The company has collected almost 40-50% from the peak. There is a fear that the electric vehicle may dent Indraprastha Gas problem in the IGL demand, but it will take time. Even natural gas is is a very cheap source of energy. The cost price are much, the running costs are much lesser than diesel or petrol, and many commercial vehicle owners, they are shifting their vehicles to the natural gas, which will benefit IGL. IGL mainly works in their main business is in Delhi. They are the monopoly, and they have some subsidy. Two subsidiaries are there, which is one is in UP. The other one is also there. I forgot that area. And these two subsidiaries is likely to add value to the company in coming years. And overall valuation looks very attractive, and one can buy IGL. The fourth one is the Newland Lab. The stock has corrected more than 50% from the peak. From 2,800, it fell to 1,000. Now some momentum is coming back into this counter. The Newland Lab has two business divisions. One is the generic business, where they export API, ordinary API as well as specialty API. That is one division. The second one is the CMS business, where the custom manufacturing solution they are providing by doing research for their big clients, and manufacturing also they do on that part. And we expect that CMS business will do very well. And they are right now more than 50 molecules they are working on. Some of them has been already commercialized. In current year, they are expecting 2 molecules to get commercialized in current year, and that will be positive for Newland Lab. Even the generic substance business, that also will do, is expected to show some business. Last year, their business was mainly affected because of the sharp increase in their raw material price, as well as one of their product sales has been stopped. That is why the stock price fell from 2,800 to 1,000 rupees. It is a good stock to watch, and coming results will give some idea on how it will do in coming days. The fifth one is the Gabriel India. It is an auto ancillary company which manufactures shock absorbers. It's a debt-free company and has some 250 crores worth of net cash in their balance sheet, and it is expected that the autos are seeing some cyclical recovery, and the worst affected has been two-wheeler in the last 5 years, 6 years. The two-wheeler volume has come down very sharply, mainly because of there has been a huge increase in the price of two-wheelers. Previously, Honda Activa, I bought it at 60, around 60,000 rupees 5 years back. Now the same vehicle they are telling at 85,000 to 90,000 rupees. They are telling almost 40-50% the price has gone up in the last 5 years. And because of that, sales has come down, and we expect that some cyclical recovery to happen in the two-wheeler space. The other big threat for the two-wheeler is the EV segment, that is electric vehicle, that is going to penetrate in the two-wheeler space, and it is expected that two-wheeler is the first segment that will get disrupted because of electric vehicle emerging. And if you see that Gabriel is supplying to electric vehicle companies also, like Ola, Ather, they are supplying to electric vehicle companies. Even if electric vehicle comes, also Gabriel unlikely to get affected because they have already started supplying to the EV manufacturers. And this stock one can consider. So these are the 5 stocks we are recommending it. And in the June month, we have recommended 5 stocks. In that, Endurance and Federal Bank did very well. Endurance is an auto ancillary company, has given very good return, 12%. It has achieved a target. Federal Bank, most probably, that also will do well in coming days. Blue Star, there has been some negative reaction, but one can hold Blue Star. SBI also one can hold. Bajaj Auto buyback, they are doing it. Actually, it was expected it will be a tender buyback, but the company has announced it is a market buyback. They have already started doing buyback, and this results won't be good for Bajaj Auto because the sales has affected due to semiconductor issues. But next quarter results onwards, it will be good, and buyback will give support to the stock price, and one can hold on all the three: Bajaj Auto, SBI Life, and Blue Star. Your Federal Bank also one can hold on. All are stable companies only. So this is the June month review. Now we will start seeing the chart. Pathanabhan will take it. After the chart, we can have an Q&A session.
Good morning. There are two charts. Generally, market tends to move in a channels in a shorter period of time, or in a short time or to medium time. So now the Nifty has given a small breakout from the downward sloping channel. For the last 2 to 3 months, from April, the Nifty is moving in a downward channel. This is the downward channel. So it has broken out from the downward channel. If it stay above this downward sloping channel, it is bullish. So we have to see 2 to 3 days more whether it is trading above this channel. So, if it stays above this channel, then the market will remain bullish, and there is a possibility that market will go. This is the support and resistance for the Nifty. As we know, the 16,400 is remain the strongest support during the market downturn. It has given support at here this point, and here also here. So it will be a good resistance when the market is going up. So first major resistance will be 16,400, then 16,800. If the markets break 16,400, then it will remain bullish. So on the downside, the two supports are 15,650 and 15,180. So one must see this level, 16,400. If it breaks it, and then the market will be positive. So up to 16,400, market will be in the range bound only. Thanks. That's all today.